Hey, good afternoon, everybody, and welcome back. This is US Home Talk. We are live every Wednesday and every Wednesday at noon on demand and at ushometalk.com. Can I talk today? Maybe I should stutter a little bit more. So we're here Wednesday at noon, and we're on demand at ushometalk.com, and we're live everywhere we find your podcasts. So whether you're on, I don't know what the Apple one is. I don't have an iPhone, so I don't know what that Apple podcast system is, but we're on Spotify, iTunes. So difficult for me to stay up with, all the newfangled things that kids are using these days.
Sure.
It's pretty tough. Anyway, if you're a podcaster, you know where you can find us, right? US Home Talk. That's what you're going to search for. So I'm your host, Mike Overson with Illuminate Home Loans. With me today is no stranger to US Home Talk. It's Marcus Walgrave with Hegg Realtors. And we have Evan Little, who is our insurance guru. He's with Paragon Companies here. We appreciate you guys joining us. So we're going to be taking all of your questions during the show today. Anything and everything dealing with real estate, mortgages, insurance, credit repair. We even cover some of that. So anything dealing with kind of the real estate umbrella, we're here to help and answer those questions. Call-in number is 612-234-7585. Again, 612-234-7585. You can also go to the comments section on Facebook and type in your questions there, and we'll answer them live on our show. Any questions that came in throughout the week, we'll answer those as well. So we'll make sure we hit those a little bit later in the show. So, Marcus, welcome.
Good afternoon.
Good to see you again, man.
Yes, sir. You too.
We're gonna cover a little smorgasbord of stuff here. We're gonna cover some foreclosure numbers in the U.S. Been some talks about how foreclosures are increasing. We're gonna uncover any truths and myths around any sort of headlines around that. We're gonna talk about mortgage rates and how the market is moving, and we're gonna cover a couple things there as well. And then we're also going to be covering a little ditty on what was that third thing we're going to do? Oh, we're going to cover home appreciation, where that's at year over year and what is expected to come up here from this year moving forward to next year as well. So,
Mike, you shared some pretty cool slides earlier in the week. I'm kind of excited for you guys for you to share to the audience, what you have, and some of them are really cool. And I'm especially the foreclosure one. I'm excited to kind of see you go over that one and dive into that topic.
Yeah, so let's actually just hit that right now. So there have been some headlines that have come out recently saying that foreclosures have ticked upwards toward pre-COVID levels. So, but what really does that mean, right? And how do we dissect that? Again, we've talked about this on the show. Can we really compare any sort of quote unquote normal year to the two COVID years? We can't, right? We can't because the COVID years were not normal. What happened during the COVID years that foreclosures were down so far? Well, there was laws that were passed that didn't allow lenders to foreclose in certain situations. So in a normal world, those particular situations would be a foreclosure that would show up on the numbers. During the COVID years, those particular situations didn't show up as a foreclosure because the lenders couldn't initiate the foreclosure process. So anytime that you see anything compared to the COVID years, you got to take it with a grain of salt. You can't really compare that because that wasn't normal. There was laws and regulations that were passed that only pertain to those particular 2 years. And either before that or after that, when those laws or regulations go away, now we're back to normal. So we have to go to pre-COVID numbers to actually get a very good comparison. So, Evan, if you pull up that graph again, okay, so we can see the foreclosure starts here in the first half of 2023. So these are actually the foreclosure starts by year from January to June. Okay, so this is January to June of every single year. So you can see in 2023, 185,000 foreclosure starts in the first 6 months of this year. 2022, there was 164,000 foreclosure starts in the first 6 months of that year. 2021, only 65,000. 2020, 165. Okay, so let's go back to normal years, which would be 2019. 2019 would be really the first normal year that we could compare to. We're at 185,000 this year in 2023 for the first 6 months. Well, in 2019, we're at 296,000. So are we more or less than pre-COVID levels?
Yeah, right. I mean, if you even if you kind of looking at like I mean, we're definitely less than
Right.
when comparing to 2019. And so when they're making the comments about our foreclosure on the rise, sure. Yeah, yes, that is a stat and that's factual if you're comparing it to 2022 and 2021 and 2020. But again, I mean, they're kind of leaving out a key a talking point, and these are headlines too. I think that's something too to kind of keep in mind as well. I mean, if you dive into these, they usually save it for like the last paragraph, maybe the last sentence in the last paragraph. They'll add their little disclosure about saying, okay, by the way, keep in mind that there was laws in place that didn't allow people to foreclose on, and then end of story. So
Right.
if you're just catching headlines, yeah, I mean, the foreclosures are on the rise in comparing to 2020, 21, 22, but definitely significantly lower than in 2019.
I mean, go back to 2011, 2012. I mean, 2008, 2009, 2010, like those were all, the big crash, right? Years either, because that was a different circumstance. I don't consider that a normal market back then because of everything that was coming out of, the 06, 07, 08 stuff, as far as, the amount of foreclosures happening, the amount of short sales happening, the loan programs that were back there, just the way that real estate was. You got to get into like 2012, 2013, 2014, when those were more normal years there. You can see we're well below those years. So, and the reason why I bring this up is because, Marcus, I'm sure you've heard this. Evan's probably heard it too, is that there's some people waiting for, right? We're waiting for the market to crash. The home prices are going to come down. There's going to be more foreclosures coming up. So now we can get a deal on a house. We've heard those types of comments. Well, it's not going to happen. We're not going to get this big glut of inventory, or we're going to get this big rush of foreclosures that are going to be showing up on the grid, because in today's world, everyone's got equity. Most people have equity in there
too.
Lots of equity.
So that's at an all-time. That's a historical high.
Right. So why would they foreclose on a house? They would sell it. If you foreclose on a house, you don't get any of your equity. The bank takes the house, takes all the equity, takes everything. So if you're in a situation where it's like, oh, we can't afford the payment, we got to do something with this house, we're either going to foreclose on it or we're going to sell it and actually take your equity that you have in there, and then maybe go rent for a year or two until things settle down again. But the amount of equity people have, like you said, Marcus, it's an all-time high. People aren't going to foreclose. They're just going to sell the house.
And Mike, you made this comment last week as well. It is a large expense to the banks, to the mortgager, to foreclose on a home loan. So if you just look at the scenario in itself, if you have a $400,000 home and the homeowner has $200,000 in equity, but they can't make their payments, and maybe they're even behind their payments in 2, 3, 4 months. If they open up a line of communication with the lender and say, "Hey, yeah, I understand. I'm not I'm behind on my payments, but I'm going to sell it." Then they're going to say, "Okay, well, we're going to give you as much time as you need to sell that house," because they know that they're not going to have to take this, eat a huge loss on it and get it going. So, I mean, you look at, again, 2023, we're at 185,580. You look at 2010, 1.65 million foreclosures when you're looking at January to June. And
Right.
just doing the math in my head, I mean, I mean, if I'm correct, it's a little bit over like 9 times as more foreclosures. So, I mean, if your niche is to buy foreclosure homes, and that's how your business is run, well, then, yeah, I mean, I think it's, you're going to, it's going to be a while. Something else is going to have to happen. And Mike, you talked about what happened in 2008, 9, and 10, and what preceded for that was, a lot of those type of loan programs that were out there, 3-year and 5-year arms. They kind of they were a lot of those loans were originated and closed on in the early 2000s. Shortly after the dot-com bubble, and those 3-year, 5-year arms, they hit their term, that 3.5, and then their rates went up, significantly, and then we rolled right into a great recession. So I mean, it was kind of like a perfect storm for that to unfold. And I mean, if you listen to anybody, any kind of economist, they all say, you know, the ingredients that we have today are vastly different than what happened, in 2007, 8, 9, 10.
Yeah, yeah, you can't compare the two. It's a completely different world these days. So, um, but it goes to show, and look at this graph too. I mean, if you look at 2018, 2019, 2020, right, all the way through the last 6 years of the starts, I mean, look how much lower it is compared to the rest of the graph. So all the regulation changes that the government made when it comes to lending, when it comes to the appraisal process, when it comes to how they underwrite loans, all of those things are coming into play, and everything they put into place worked. If you look at this graph, because look, the amount of foreclosures are significantly less. So a lot of people thought that lending swung too tight, right? They were really loose, and that's what caused the 06, 07, 08 stuff to happen. And then they swung way too tight. And that's, that's one of the arguments that some people are making. But you can see the amount of foreclosures here are significantly less. And so those regulations, would be technically working if you're looking at this graph.
And obviously, the topic that we have on hand here in today's environment is inflation. This isn't the looseness of policies. It's a different topic that the Federal Reserve is trying to take on.
Right. Yep. Exactly. So let's go to mortgage rates. So Evan, once you bring up the next slide, so I want to show this graph here because this is the mortgage-backed securities market. So if anyone follows any sort of market, stocks, bonds, this or that, you've seen these candlestick graphs before. So this is the mortgage market here for the last 6 months. The reason why I'm showing this is because it looks like an EKG, right? It's all over the place. It's up, it's down, big up, big down, little up, little down. It's all over the board. It doesn't resemble a flat line by any stretch of the means. And so I put this slide on here to show people how much rates are bouncing around right now. So in general, if the candlestick is lower, so if you're looking at this graph, the lower the candlestick, the higher the interest rate. Okay, that means the higher the candlestick, the lower the interest rate. Today is the far right on this graph. So the big red blob on the far right, that's today. Today is a bad day for interest rates, okay, because of how low that candlestick is. Go back 2 weeks, rates were looking pretty good. Then you go back to July 7th, the very lowest candlestick on this one, just back on July 7th here. Rates were at their worst point that we had seen in the last 6 months. So rates have ranged in the last 6 months from about 5.99 up to 7.5. And so things are going to be a little shaky, right? So a lot of people are like, rates are going to get better. They're going to get worse. It's definitely not going to be a straight line, whatever direction they go in. I still think they're going to go down typically, or in general. But like I said before, it's not going to be a straight line there. You're going to see ups and downs. You're just going to have to ride the waves a little bit, and trust your real estate agent, trust the loan officer you're working with to try to put you in the best position.
Yeah, I think when you see this volatility, and I'm glad they have it, color coded with green and red. That's always a little bit easier to follow. Green is good. Red means stop, but I mean, talk about an emphasis of making sure that you are aligning yourself with an experienced mortgage broker like Mike Overson is, somebody who can see this stuff and say, hey, I know you're getting anxious because the rates didn't get good today. Excuse me, they were worse today. But don't worry. I think we should ride it out for a couple weeks and try to lock in a rate in 2-3 weeks, instead of kind of getting caught up in the emotions and the fears of things. Rely on your expert and take their advice for these type of decisions.
Yeah. Evan, is this what an insurance cost graph would look like recently?
No. Insurance costs are significantly more stable because they have to be approved and regulated by the state. So generally speaking, insurers, it depends on the state and regulations and stuff, but often they can only change their rates 1 to 4 times a year.
Oh, interesting.
Yeah, and they basically get one crack at the egg. They have to justify it to the state regulation board and so on. But like if I do a quote for you, Mike, today, that quote will be the same until new rates go into effect, right? So if I did another quote for you a week later, right, it would be exactly the same. The trick is there is no like, oh, January 1st, the rates change. It's just sort of like they get to do this process once a while, but when that actually happens, the company just kind of, it happens. So
it's not a scheduled change. It's a change just kind of whenever it happens. It's not going to happen every single day, where as far as mortgage rates go, I could give you a rate quote today and you call me tomorrow, could be 0.25% different. Right.
It could be different at the beginning of the day versus the end of the day for you, right? Whereas for us, it's a lot more stable than that. That said, it also can be the case, like we were talking about with the California stuff, where a company can just issue a memorandum saying that they're no longer doing a certain type of business effective immediately or the end of the day or whatever. And we have to respect contracts that are in force. So like when State Farm said that they were not going to do any more homeowners policies, they said effective midnight tonight, we're no longer binding new policies. They still have plenty of people on the books there, but they were just saying we're not writing new business. Those are the sorts of things that can come up very short term, where a company can just be like, yep, we're done. We don't do this anymore. We're no longer doing personal lines, or we're no longer doing business lines of credit or whatever. So
gotcha. Yeah, it's interesting how each piece of it can work. And COVID was the craziest thing. So, I mean, I think I might have told you guys this story before, but I remember like it was yesterday. We're 2 weeks into COVID, right? Financial markets have no idea what to expect, how to react, what's going to happen. Do we increase? Do we decrease? It's one of those things where it was crazy. So I called the guy up Friday morning. It was at 9:00. And I said, hey, your rate right now would be 4.5% if you locked in on a 30-year fixed. He's like, I don't want to lock down. Let's wait and see. Let's see what happens over the next few days. Right. I called him up later that same day. So I literally called him at 3:45 that same day. And I said, if you were to lock right now, your rate would be 3.5%. So it started at 4.5 at 9 a.m. It went to 3.5 by 3:45 that same day. So it dropped a full percent. Never seen that before in my lifetime, right? I've been doing loans for 21 years. Never seen rates move that fast, within hours, right? So that's how crazy COVID was. So typically it doesn't change that much. I mean, if you change a quarter in a day, that's a big movement. A big movement would be 0.25% a day on the loan side of things.
In today's market, or pre-COVID, a 0.25% in one day would be considered to be a pretty hefty jump or decline for that matter.
Right. Absolutely.
And you see ACE changing daily. That's probably a common, or at least maybe once or twice a week, an eighth change. That's something that you do see, Mike.
Yeah. An eighth here, an eighth there. I mean, that's very common. If you go back to that chart, you can see that there wasn't a whole lot of time frame in there where rates were staying the same. June was actually a good month. I liked June this year. Not because rates were that great. It's because rates were steady. like the entire month of June, it didn't go, if you draw a line across June, it was never more than a quarter up or a quarter down from that line. So it was predictable for people. It was predictable for loan officers. It was nice. We got into July, things started shaking up a little bit more, bigger swings. So, but I do think in general, like I said before, from now to the end of the year, rates will decline a little bit. That's what my gut is telling me. It's not going to be a straight line, but I think we'll be lower at the end of the year than we are now as far as interest rates go. Okay, so let's get into our last topic here, appreciation. So this is going to be a fun one here. So I've heard a lot of people saying that with rates where they're at and with home prices, what happened with them over the last 2 years of going up, that they have to come down, right? It's a perfect storm. Home prices have to come down. And so I'm going to wait to buy because I think I'm going to get a better deal on a house, next year or later this year versus now. So this graph here, this is from CoreLogic. So one of the bigger players in the game as far as real estate goes for forecasting what's going to happen with home prices. So you can see currently month over month, we're up 1.2%. Year over year, we're up 2%. And this is nationally again. Okay, so each market is going to be a little different, but nationally, month over month, we're 1.2%. Year over year, we're up 1.2%, and then year over year, 2%. Look at the forecast moving forward. Let's look at the year over year. So from April 2023 to April of 2024, they're estimating that home prices are going to go up 4.6% in those 12 months. So for the people that might be waiting because they think home prices are going to be coming down and they're going to get a better deal on the house, I don't think it's going to happen. And CoreLogic doesn't think it's going to happen either.
Yeah. And I know Jason and I were talking about this earlier in the year, maybe about a month back, about forecasting, and it seemed like he kind of was, from what he was seeing, he thought the Twin Cities market was going to be somewhere in that 6% plus increase, for the year of 2023. And I thought, my market here in the Sioux Falls, South Dakota area, we may be a little bit less than that, that maybe 4.5%, 5%. And that, but again, I mean, that's what a lot of the large data collectors like CoreLogic, they have the data, and that's kind of what they've been forecasting. And that's what we've been seeing too. I mean, we definitely saw, there was a couple months, when things started rolling in like April, May, June, things were on fire. They were super hot. It kind of fell into that spring market behavior. And I'm sure, we're going to see some cooler months here this fall or early winter that'll kind of level out. But yeah, I mean, if you think that you're have an opportunity to wait and get a better deal, it's not likely going to happen. I think a lot of people have mistakes when they go on to like Zillow, right? They go on Zillow and they look at the Zestimate. And the Zestimates are saying that, okay, well, according to the Zestimate, this value of this house has gone down 10%, in the last 2 months. And they're not the same statistic, that you're not comparing apples to apples. Or furthermore, when people see something like, okay, well, I've been seeing price reductions happening. It's like, well, sure. I mean, I've been seeing that as well. But the fact is that, if you buy a house today, it had more value today than it did 3-4 months ago, regardless of a price reduction that you may have seen. So a lot of sellers, what I've seen, have maybe just come out of the gates too confident, too strong, too high. And they're simply just having to reduce the price because the buyers are just simply saying, hey, you're just a little overpriced. You got to get it priced correctly for us to, inquire about private showings and submitting offers.
Yeah, we still see some sellers reaching for that number. They're still reaching for a number that's too high. And that's a killer. It's the dagger for a seller because you get shop worn. So your first showing is not when buyer number one goes on there and schedules a showing through Showing Time and actually physically visits your house. Your first showing is when your house goes live on the market and people are looking at it online, right? So when you put a fresh listing out there, okay, and you have, let's just say up here, let's say we're in the outer ring suburbs of Minneapolis, you put a fresh listing right in the meat and potatoes price point of Lakeville, let's say. You're putting it at 450,000. Okay. You got 800 people that in the first 24 hours have looked at your house online. So 800 people. Probably get maybe 20 people that heart it as a favorite, and maybe you get 1 or 2 people that schedule a showing right away. Okay. So if you look at that, you've had 800 showings at that point. Okay. You've had 800 showings. 800 people have looked at your house. They've looked at the pictures online. They've seen all that. They've made a decision in their head of that house is priced too high for what I'm going to get out of it, or it's something that I like. I think it's priced correctly, or we better run to this one and set up a showing right away because we really, really like it at the price point. Okay. So if you go on the market and you price too high and you don't have people hearting it or saving it as a favorite, you don't have showing set up, you know within the first few days if you're too high or not. Okay. So you got to look at that data, and you got to look at, you got to look at your competition that's out there, and be able to analyze that feedback that you get, on the MLS with your agent to say, hey, look, we put this on the market here. We went at the price that you wanted to go at here. We've had 800 people look at it, and we've had no showings, no activity set up. We have to start reducing the price. Once you start the price reductions, Marcus, I'm sure you can attest this. As soon as you start the price reductions, then people are like, well, what's wrong with the house, right? And then they say, oh, the sellers are getting desperate because they're dropping the price now. Let's lowball them. It's like that's the type of thought process that buyers have. And that's why it's really, really important to listen to your agent and go in at a price that your agent recommends versus what you think you might get if the one random person that might be willing to pay that much for your house comes along the way and sees it.
The buyer behavior right now is definitely unique, right? I mean, there's definitely some of the traditional behaviors that we're seeing. Like you said, Mike, I mean, if it is overpriced, people are simply just not going to schedule showings. And what I've noticed here in our market is if you are overpriced, but the narrative out there is out there in terms of a super low inventory. So it's not that the buyers are not wanting to see your house because it is overpriced. A lot of them, they're concerned about submitting an offer below this price because of the low inventory. There are still some bidding wars going on out there, especially when homes are priced, at a fair market value. Then you're definitely getting bidding wars. But these buyers are seeing, they're like, God, we'd like to see it, but it feels like it's overpriced. It just hit the market. They're not going to entertain an offer underneath list price right now because of the low inventory. And even though that may not even be true, I mean, I'm still getting some sellers right now that are saying, hey, let's list it a little bit above what you said because we can always negotiate. We can always negotiate down. But right now, the buyers, they're intimidated to simply submit an offer. They don't want to, they'd rather say, okay, well, we're going to continue to look. And if this house is still in the market in a week or two, and they haven't price reduced, well, then maybe at that time we'll go schedule a showing, and if we love it, we'll submit an offer. So, but to your point, exactly, Mike. I mean, you're trying to play this crystal ball of saying, hey, maybe there is that one buyer out there who doesn't care that it's overpriced because they love it as much as we love it. And is it possible? Sure, it's possible. But I think, in my experiences, the vast majority of the time, a seller is going to have a better experience and likely net more money if they come out of the gates at a fair market value. And buyers are the ones who dictate the value, right? I mean, we have the data to say, hey, here are 3 awesome comparable sold homes that I found that have closed in your neighborhood in the last 90 days. These are great comps, and that's why I'm so confident that your house is worth at least this. Here is a list price range that I suggest based on what you're trying to achieve as a seller, your personal goals with your real estate needs. Here's my suggestion. and and we'll go from there. But ultimately, again, it goes to the buyer. I mean, even if you came out of the gates at a CMA value, you didn't price it $1 above it. Well, if the buyers still feel like it's overpriced, I mean, there's nothing that we can do. The buyers are the market; they're the ones who dictate, the value of a home. Same reason why when you get into a bidding war, if you have 5 buyers who feel like your house is undervalued, well, they're going to submit an offer, and they're likely going to, because there's multiple offers, they're going to say, hey, you know what? We don't feel like this is a 450 house. We kind of feel like this is a $500,000 house, because we've seen like half a dozen other ones that were 480, 490, and this is just as good, if not better than that one. So we're confident in submitting an over list price offer. Again, buyers are the ones who determine the true value of your home.
Yeah. Yeah. I mean, I would still go back if I was to list my house, I would list mine under what the agent would suggest. My goal would be to get multiple offers on the property, because I've seen what happens when the buyers I'm working with on the loan side of things, what happens when there's multiple offers on a property, right? They're calling me to say, what's the max that I can offer in this house? What's the max I can qualify for? Right. And then they're talking with their agent to say, hey, how high do we think we need to go on this house as far as our offer price goes in order to get it? And the agent's like, well, it's listed here. Likely you're going to have to go to this number, right, in order to get it. But if you go in at that number and you lose it, is it worth losing this house that you really, really want by, not going up like by another 1,000 or 2, just to try to outsmart the other person? And it's this whole back and forth of, you play these mind games, like, well, what's the other person going to offer? I got to offer like 1,000 more than that, so what I think they're going to offer this, so then I'm going to offer that. And that's how you get the most for your house. Right. So for the last probably 3-4 years, the strategy that I have seen is that you obviously listen to your real estate agent. They're the expert in your local market. Don't overprice it. If you're going to do anything, underprice it, get those multiple offers, and you'll net more at the end of the day.
There's a lot of benefits to that kind of approach too, Mike. I mean, again, in a more traditional market, if a buyer does feel like they may have paid a little bit above market value for a home, property inspections are being more commonly used in offers that are getting accepted, and they're going to look at it and say, you know what, we do feel like we paid absolute top dollar for this house. So, and based on what we know from the disclosure report, and so anything that does come up on the property inspection report, we will expect the seller to take care of all of it, because we paid top dollar for it. So again, to your point, I mean, if you're looking for maybe the most pleasant experience, or if you just simply want to have the most leverage, throughout from the beginning to the closing table, that can be a really good strategic move to price it to a point where, if there are a laundry list of small little things, a couple $100 for this or a couple $100 for that, you can simply go back to the buyer and say, yeah, I understand that there's some, little wear and tear here, but we had 5 offers, or we had 10 offers on this home. If you want it, it's yours. None of this is affecting the integrity of the structure. And we're not going to spend, the next 2 weekends, doing touch up paint, replacing plugs in the sink. That's something that you can do as the homeowner. And if you don't want to, that's fine. We'll just go back to the other 4 or 5 offers that we had and see if they're interested in it. So it just kind of depends on your situation, very specific to your situation, and can make the right kind of plan for you guys.
So, yep. So, lessons learned here today, just to do a little recap. Foreclosures, you're not going to see a big glut of foreclosures coming up. We're not going to see this huge rush of inventory come up that's going to have home prices come down and things like that. Definitely not going to see that here. Interest rates, they're going to fluctuate just like they have been for the last several months. They will eventually settle in, but that's, determined on, when inflation is under control, and really when the Feds kind of have their narrative of saying, look, we got inflation under control. It's tracking in a straight line the direction we want to go to. We're not going to raise our Fed's funds rate anymore. Everything that we've done is working and it's calmed down. that's when we're going to see our interest rates start settle back in and be more predictable. And then thirdly, if you're planning on waiting to buy a house, thinking that you're going to get a better deal, probably not going to happen based on the appreciation chart that we saw earlier. People who wait, another year to buy a house are probably going to miss out on, 4 to 6% appreciation in their pocket. They're going to be ended up paying an additional 4 to 6% for that same house a year from now.
Yeah, we've talked about this. I mean, you kind of have the software to show like the cost of waiting, right?
Mm-hmm.
And I tell you what, I feel bad that with the number of individuals who thought that this was going to happen, this like huge foreclosure inventory boost, the big decline in the value of homes was going to happen, and they're like, you know what, I'm going to wait, and man, if they could have got into their house, a year ago or 2 years ago instead of paying rent, and the amount of equity that they would have built just through appreciation over the last 24 months, the rate that they could have locked into on a 30-year mortgage, at that time, it's just like jeepers. Like they missed out on not just thousands of dollars, tens of thousands of dollars.
Yeah, absolutely. Yeah, it's pretty staggering, the numbers, but it's not. And the point is, it's not too late either. Like we
No.
truly believe, if you talk to any industry professional, it's not too late. If you wait a year, you're going to be negative again. You're going to pay more for that house. And with what we've seen in inventory levels going back the last few years and moving forward, our inventory is not going to go up that fast. So it's a pretty safe bet that when you buy a house today, that you're going to see that 4 to 6% appreciation in that home over the next 3, 4, 5 years. And take a $400,000 house, 4% a year, that's what, 16 grand, 16 grand times 4 is what, for 64,000. That's $64,000 of free money in your pocket because you bought today versus waiting. So,
yep. And I have seen a couple forecasts here in maybe the last couple months in terms of like pre-existing home inventory picking up. I mean, the builders are doing the best they can. They're running their obstacles that they're running into are the cost of land to develop the land, extra regulations, with developments, labor is a thing too. They're building, as quickly as they can, but still in a smart and safe manner. We're not that far removed from a time when we did go into the Great Recession, where they were sitting on an incredible amount of lots and spec homes. So a lot of those builders, especially the smaller builders, they're just like, we're not taking that risk. We're not going to go ahead and knock out 10, 15, 20 specs and let them sit out there. Maybe some of the big builders can do that, because they're developer builder, kind of in one entity, so they can kind of reduce their overhead to create these homes. But in a nutshell, the builders, they're just not in a position where they can simply fix our inventory problem. And what I'm alluding to is the pre-existing homeowner. A lot of them, they are just kind of like, God, I really like my COVID interest rate. That 3% is pretty awesome. But as always in real estate, when the time comes where it's just time to move up or downsize, they're going to do that. And so maybe in a couple of years, we're going to see that pre-existing inventory have a nice increase. But as of right now, inventory is forecasted to stay low and for the immediate future. And I think that's to your point, Mike, where we are going to see those interest rates come down once we kind of get some more stability instead of this volatility with the mortgage rates.
Yeah, when that happens, hold on, because I know what's going to happen, right? We're going to be back to the 20 to 30 offers on every house. You're going to have to offer over list price, so that's just another reason to buy now versus waiting, because you can always refinance down the road to a lower rate when rates do get lower. If you throw yourself as a buyer into that mix when rates are lower, guess what? Everyone else who's waiting for those interest rates to come down, they're also going to jump in the pool at that point. And you're going to create a very competitive buyer market again, where, we saw it, Marcus, there's just a lot of the buyers ended up just kind of giving up a little bit, just because it was multiple offers on every single house. They would offer on 6, 7, 8, 9 houses and not get one. And then, they get a little frustrated and go back to renting. So
good stuff, Mike.
Yeah, we'll see it. So as we come to the end of our show this week, we want to thank everyone for tuning in live or catching the podcast at a later time. You can find us anywhere you find your podcast and on our website, ushometalk.com. We are here to help you with all of your real estate and financing needs here in Minnesota, South Dakota, and the entire United States. This is Mike Overson and Marcus Walgrave signing off. Have a great week.